so there's two pockets of distinct distress in the FHA portfolio that will be impacted when the music stops in February 2026 or earlier. The first is what I've dubbed the modifications of doom.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a really enlightening and detailed discussion on tap on the FHA mortgage crisis and real estate market, and it's lined up with John Comiskey, who we're very fortunate to have with us. He's the founder of Reverse Engineering Finance Substack. It's a newsletter that explains the underlying mechanics of the financial system and then uses those mechanics to make projections. John's an engineer in the mortgage technology sector and a non-practicing attorney. John, welcome to Metals and Miners, and thank you so much for joining us today.
Thank you, Gary. I appreciate you having me on.
Yeah. So, John, with 6.5% mortgage rates stalling demand, how sustainable is this environment, and what might a drop to 5.5% do to FHA delinquency rates?
Well, I mean, a drop to 5.5% or maybe even lower for FHA delinquency rates, it bears on those rates because of the kind of mechanics behind modifications, right? And what the FHA can do to assist troubled borrowers, right? Like when you're at 5.5% or 6.5%, if you already have the loan, you have the rate that you have, right? So a drop in rates isn't going to per se help you out unless that loan is modified. And the problem is while a drop from 6.5% to 5.5% would bring payment relief for some of the FHA portfolio, it likely wouldn't be enough just going down a point. You probably need to go considerably south of there to really get the type of drop in rates that would help the modifications that were performed over the last couple of years that raised the rates from really low rates when the loans were originated, and give those borrowers
is that because of a high percentage of those rates are, let's say, sub 5.5% or sub 4.5%?
Yeah, that's how they started. So you've either got loans that have never been modified and they're still at those pandemic era type rates, in which case a drop from 6.5% to 5.5%, if you're struggling because you can't make your 3.5% rate or your 4% rate, isn't really going to help you.
Yeah, that makes sense. All right, so there's talk that the conforming loan limit will be capped at $500,000. It's currently at $806,500. How would this change? I mean, that's $300,000 south. How would this change impact economic growth, migration, sales, et cetera?
Well, mechanically, what that would do to the mortgage finance industry, right, is right now, when you're buying a home and if you're financing it, which most people are, if you want to buy a home in the range of $500,000 to $800,000, you can finance that readily with government-backed in some form mortgages, either the GSEs like Fannie and Freddie or FHA. You can readily get financing for that because the lenders, they can readily get their liquidity back. The lenders lend you the money at the table, but then they go and package these mortgages up in mortgage-backed securities with either Fannie and Freddie or Ginnie Mae. And they can readily do that between $500,000 and $800,000. But if the conforming loan limit dropped from $800,000 to $500,000, then they won't be able to so readily and easily do that. So somebody would have to make up for that lending. Would banks do it? maybe, but banks by and large haven't, they're not really interested in holding mortgages on their books because of treatment under Basel III, et cetera, unless those mortgages are to people, super high net worth people where the relationship matters more than the actual mortgage asset itself. And you're probably not going to find that many of those folks in the 500 to 800,000 range. So what it means is you would have to get, like, for financing in that space, you would have to be like a return to private securitization, like pre-financial crisis. And while to a degree some of that would happen, the credit risk now needs to be priced in on those mortgages. So it'd be much higher, right, than knowing that the government is going to make you whole one way or the other. Bottom line, long story short, honestly, that's probably the most significant thing in my mind that the housing agencies could do to lower lower home prices, just because it would be difficult to buy and get financing for a home in that range if they were to lower that. And that, of course, would have a significant downward effect on home prices, I would think.
Do you have a sense on if that's going to pass?
Well, I mean, I hear sources that I know have friends in, I don't know, the know, right, who say yes, but then I think over the weekend or maybe just before, Bill Pulte, the new director of FHFA, said flat out that they weren't considering it at this time. So to be honest, I don't know.
Okay. All right. So, John, you've discussed homeowners clinging to low rate mortgages, freezing the resale market. How does FHA's payment forgiveness complicate that?
I'm sorry, repeat the question real quick.
Yeah. Homeowners have been clinging to these low rate mortgages. It's freeze the resale market. We have the FHA's payment forgiveness situation. How is this complicating the freezing of the market?
Well, it's kind of enhancing it, right? The housing comes to, or supply comes to market for a variety of different reasons, right? One of which is that people move. And I think that's what you're seeing, these super low rates right now, and that lock-in effect that people who would otherwise move aren't, because if they move and they got to refinance the next home, then they're going to get it at a much higher rate. But there's other sources of housing supply, one of which is like the delinquency or default channel into housing supply, which is for sales, short sales, or foreclosures and the like. And that is where the FHA loss mitigation procedures really enter in. They have effectively made it where there's been very, very little housing entering or housing supply entering from that default channel from FHA, because the FHA has basically been covering the mortgage payments in one form or another of many of these borrowers. And so those existing borrowers have stayed in the home.
Yeah. Well, let's get into that very thing that you just brought up. They're covering payments for delinquent borrowers, sometimes extending the terms to 40 years. How sustainable is this given the 70% delinquency rates? And can we get some examples of what you're seeing and tracking these days?
Sure. So from a sustainability perspective, it's more like a policymaker's willingness to sustain it, honestly. I mean, if they wanted to, they could keep this going, for another 5-10 years. I don't think they will. I think there's public pressure that's building on them to not. But in theory,
there is technically a stop date. You and I were talking about this off camera. Would you go ahead in this part here, just really briefly share with folks, when is this policy supposed to end? When was it supposed to end? And why do you think that has changed? And do you think it's going to wait till the end date, or do you think it's going to be halted earlier?
Okay, so quick history of it, right? The ultra loose FHA loss mitigation procedures, they were slated to expire on late April, is it the 25th or 30th of this year. So next month, at the end of next month, they were slated to expire. And that will, when they tighten up to the new loss mit procedures for FHA, that will end a lot of the nonsense that I'll show you some examples of here in a minute. And that would actually be the forcing function that would start to take those modifications, those 70% delinquent modifications, and push them towards foreclosure or for sale before that. So it was originally slated for April, but then on January 16th, the FHA extended that the ultra loose COVID era loss mitigation procedures. They extended them until February 2nd, 2026, so next February, giving essentially 10 more months of these procedures to come. But that's problematic for a Trump administration because February 2026 that marks the beginning of a midterm year. And I don't think you politically want a stark rise in FHA foreclosure activity to happen during a midterm year. So I think that the Trump administration is politically incentivized to actually kind of stop the music earlier, like was originally scheduled before it got changed on January 16th, which is, I don't know that to be true, but it certainly would make sense for them to want to do that and blow it up early, if you will.
Okay, so that's what you're expecting. We don't have any hard dates at this point.
Nope.
The only hard date we have is February 2026.
That's correct.
Okay. All right, so let's get into some of these examples that you've been posting on X, that you've been tracking. Explain to us, what is going on here? What are we looking at? And how egregious is this?
Absolutely. All right, so I'm going to share my screen real quick, Gary, and pull them up.
Okay.
All right, fantastic. Are you able to see the loan I have on screen?
Yes. Perfect.
All right, so these come from my FHA Loan of the Day series, where I would highlight particular FHA loan that I found in the MBS data, go back through its payment history, and talk about what's happening on the loan. And I've selected 3 to kind of talk through what are the patterns that are happening. Like when I say the FHA pays the last 30 mortgage payments for a particular Washington, D.C. borrower on an $869,000 loan, what are the mechanics of that? How do I know that? What am I inferring from the data to say that that's the case? So let's dive in. So for this particular borrower, first payment date on the loan was 4/1/2022. So originated a couple of years ago, nearly 3 years ago. Had a loan amount of $869,000, rate of 3.25. There's its payment, about $5,000 a month when you take principal and taxes. And it's a refinance loan. So the borrower actually had 12% roughly of equity when this loan was originated. So let's take a look at its payment history. As I point out, borrower starts out paying, makes the first 6 payments, but then they stop. So how do I know that? Well, specifically, taking a look at the payment record, you can see our first payment date, 4/1/2022, and we can see the records that we get each month in the Ginnie Mae MBS disclosure data for this particular FHA loan. And their months delinquent starts out at 0 and remains 0 for about the first 6 payments. And then they become 1 month delinquent. And that's what happens when you don't pay in these records. You'll see it reflected as the months delinquent will grow. And if the borrower the next month made 2 payments, then their months delinquent would go back down to 0. If they made 1, it would stay at 1, and so forth. So using this, I'm able to understand the payment history of what's happening on these loans. All right. So continuing on.
I did notice that on the extreme right of your chart there, their debt to income is over 50%.
Correct. Yeah, 50.76 on this with a origination credit score of 628.
Yeah, so they've got a low credit score, they've got a very high debt to income, and I thought that the cap cutoff was 43%.
Uh, it is not. The FHA has they have loans with DTIs up to 60% that I've seen.
Okay.
Um, okay, so this borrower, and this is where I pose the question: is the borrower truly in trouble, or did they just have that moment when they realize, hey, the FHA will actually lend me the money interest free to make that payment? And the truth is, I don't know in a literal sense, right? I mean, all I can do is infer what I see in the data, but it's a consistent pattern that you find in a tranche of these loans across the data. So if you want to believe that no, this is not strategic non-payments and that there is legitimate trouble here, then one's free to believe it. But I infer that they're probably not. This probably is strategic non-payment. So why do I think that? Because picking up the payment history, and this is where we left off, that first month of missed payments. So now you see they just descend right into they've stopped paying. So they're 2 months behind, 3 months behind, 4 months behind, 5 months behind, 6 months behind. The data doesn't report 7. Everything is 6+ is 6. But if you'll look, our unpaid principal balance on the loan, which will gradually tick down as the mortgage amortizes with every payment, isn't. It's staying the same. So this indicates that they are making no payments on the loan until October of 2023, when all of a sudden it flips from significantly delinquent, right, probably 10, 11 months, to being current. And this is kind of the signature of a partial claim. And again, do I know with metaphysical certainty that a partial claim occurred? No. In theory, they could have hit a scratch-off ticket and got a big chunk of money and sent it in to bring their loan current.
Or maybe they were taking their monthly payment, putting it in getting 5% on their money, and then after 10 months they decided to keep the interest and pay their balance.
I mean, it could be, right? It's just not very likely that is in fact
not with a 628 credit score and a 51% debt to income. No, definitely not.
So almost certainly a partial claim brings the loan current. And actually,
before we move on, when you say partial claim, would you explain to everybody who's listening, what do you mean by partial claim here?
Absolutely. So the FHA mortgages it's largely a mortgage insurance program, right? FHA borrowers pay into a mortgage insurance fund effectively, or when the loan is originated, they pay a lump sum up front, although oftentimes that gets financed into the loan. And then they pay annually. They pay if they're paying. They pay an annual percentage of the loan as a premium for this mortgage insurance, and then the FHA uses the money that comes into the mortgage insurance fund from borrowers who are paying their mortgage and originating loans, and it uses it to pay out in case the loan defaults and goes to foreclosure and there's a loss and they have to pay out on claim, and they'll do it a partial claim to bring a borrower current. And to be sure, there are legitimate uses for partial claims, like as a one-off to help a borrower who is paying their mortgage, hit a legit rough patch. Maybe they lost their job, had a medical issue. It gets resolved. 5 months later, they're able to keep making their mortgage payment. They just can't come up with the money for the missed payments. FHA effectively pays the servicer for those 5 missed payments and brings the borrower current. It's not partial claims themselves that's the problem. It's the fact that you can string them together when they loosened the loss mit procedures, and there's no waiting period, and they don't check to see whether or not or they don't care whether or not you've actually made a payment since your last partial claim, which may have been only 5 months ago. That's the problem. That's what's getting gamed. That's what's being chained together.
And these people are in the know enough to realize that they can have their loan modified like this and basically receive interest-free money.
It's a good question. I can only infer what I see in the data, but when I see literally no payments being made, because we did a partial claim here and then they immediately did not pay on it. 1, 2, 3, 4 months, and now they're seriously delinquent. They cure. 1, 2, 3, 4, 5, 6, 6, 6. Again, the UPB is not dropping. Another partial claim. I mean, maybe they just genuinely been struggling this whole time, or they figured it out.
And what's the total? What's the calculation for the partial claim, for the total partial claim that the FHA can make before they say, okay, your allotment is done? Because like in this case, this person, that's three times in the records that they went multiple months where they didn't make a payment and a partial claim was made on their behalf by the FHA. So at what point does the FHA say, okay, you've hit your limit, buddy. I can't give you any more?
The statutory limit on partial claims is 30% of the unpaid principal balance at time of first claim. So for this particular borrower, that would have been, let me go back up here, 860, 592, whatever 30% of that is. So
a little less than
260. Yeah, something like that. That's the cap on this particular loan. So
a lot.
It is a lot. I mean, literally, if this borrower kept doing this so long as the procedure stayed the same, they would get up to a $260,000 interest-free loan. That interest-free loan over a term of 30 years, because the partial claim doesn't need to be paid back to the FHA until mortgage maturity. It'll be paid back at refinance or if they sell the house, if that happens before, but they could have a $260,000 interest-free loan for up to 30 years.
So does that act as like a second loan?
It does. It's a junior lien that is held by the FHA that bears no interest, repayable at the end.
Okay.
And yeah, that's kind of the point of this particular loan, is to show what I've taken to calling the partial claim gravy train, where they're just stringing them together. And not all borrowers who are taking advantage of them, of partial claims, are so blatant with the use of them. Some are making payments and trying to make payments and just struggling. Although that tells a very different story on a loan, which is, while it may not have had a modification yet, and it might not be seriously delinquent, because every time you get a partial claim, the next month you're not delinquent at all. You're current, so you drop from the delinquency rates. But the reality, when you step back and look at the payment history as a whole on the loan, it's that loan is in trouble when the loss mitigation procedures tighten up and they are required to meet regular payments again.
Excuse me. What's the impact, if any, on their credit history and on their ability to secure a future loan?
Oh, it'll wreck the credit in current times, right? These are serious delinquencies that should be being reported to the credit bureaus. I've heard some whispers that, well, not really whispers. I've heard people that I don't know, but that seem like they mostly know what they're talking about, that say in some situations they don't see these things come through, but by and large they should be coming through. They should be wrecking the borrower's credit, which will of course impact their ability to get future financing.
So this person's 638 credit score should be a lot lower.
Yes.
In light of this, of their egregious.
Yeah. 100%.
Yeah.
So moving on to the next kind of pattern, which is the pointless modifications. So the FHA keeps this Florida home off the market. It raises the payment on a modification from $1,400 to $1,783, which for anybody who is familiar with the concepts of loss mitigation that's crazy with a modification. Modifications are done for two reasons. One is to provide the ability to cover the arrears, right? And those are used extensively, before partial claims, standalone partial claims, where the FHA would make that to cover the arrears. Instead, you would normally roll that into the principal of a loan modification. But really, the primary purpose of a loan modification is to try to bring the borrower who's legitimately struggling some payment relief. And if
this doesn't do that,
no, this goes like completely counter to that, right? Which when you look at it, you're like, why the heck would they do that? That's absolutely nuts. So this loan tells kind of an interesting story in and of itself. So we start 9/1/2020, loan amount of $281,000, our rate is 3%. Borrower makes a payment, but then very quickly goes into default. And 15 months later, the loan is modified.
So they literally were living there for 14 months, mortgage payment free. They paid one,
yeah,
and then went 14 straight months without making a payment, and then after 15 months, it was modified.
Yes, that's correct. Actually, I think no, that's correct. Yeah, 15 months.
Wow.
And you might ask, well, why not do a partial claim here? In 2022, February of 2022, when rates were still near historic lows, modification was actually helpful to this borrower. Did this borrower need it? Were they struggling? Were they gaming? Who knows? But let's assume they were actually struggling and needed some payment relief. They could get that payment relief. They could get that payment relief from two mechanisms. If you'll note, their interest rate at 3%, it didn't. Let me see what the modified rate is. All right, so the interest rate actually it rose up a little bit, right? So that's going to hurt. That's going to hurt in trying to get a lower payment. But you'll note that the principal balance on the loan dropped down to like $230,000 from.
Where did that $50,000 or $60,000 go?
You mean where did it come from? Like where did the obligation for it go? Well, that shifted to the FHA. So this is what happens when a modification and a partial claim are done in tandem. And what happens is a modification is performed, right, which has to set the rate to market, which fortunately for this borrower was only 1/8 of a point higher than what they had. But that's not going to lower the payment. So instead, or in conjunction with this, the FHA pays a partial claim of what ended up being like $55,000 to lower the principal balance. So now when we amortize this loan at 3.125 over a 30-year term, now we can get some meaningful payment relief.
But then they have a second of the 55,000 on there. So it seems like it's an accounting gimmick.
In a way, it's an accounting gimmick. But then that second bears no interest and it's not payable until the end. Okay. So it gives them a more affordable payment right now that, like, the loss mitt theory is this borrower needs time, but then they'll be able to figure out how to be able to afford the mortgage and go forth. It gives them time to figure it out, which is why meaningful payment relief is a cornerstone in any loan modification that is legitimate loss mitigation. So in that sense, I don't quibble per se with this modification. It was this isn't necessarily extend and pretend, notwithstanding the fact that the borrower had made one payment on the loan.
Except they then stopped payment again.
Yeah, and that's the issue, right? So what did the mod do? Well, it lowered the payment $200 a month, right? That's but it also used most of their partial claim allotment, because while we see the principal reduction, the partial claim also had to cover the missed payments. So all that together was about 73K of their total 84K that's available to them. So they have little to no partial claim ammunition for a future loss mitigation workout. And is that $200 enough? Did it stabilize the borrower? I mean, it helps. Like the borrower's fighting here. This isn't just, oh, this borrower is nakedly grifting. You know, they get behind, but then they make 5 or 6 straight payments. They get behind again, they make a couple payments. They get further behind, but then they make double and triple payments. Like this is a legit struggling borrower. At least that's
okay. And what's their debt to income ratio? I can't see it on my screen.
Yeah, let me scroll over. 56.10, right?
This seems to be a pattern. Okay.
Yeah, for sure, for sure, right? And eventually it's just not enough, and the borrower goes very seriously delinquent again.
It's because their overall financial picture is one where they just can't afford this particular house, this particular mortgage.
That's right. Even with a meaningful payment reduction from what it was originally when they originated the house, you know, that they can't do it at $200 less than what it was, than what the original mortgage payment was. So, you know, traditionally on loss mit, this is the time where the servicer and the borrower have to explore disposition options, right? Either selling the house through for sale or short sale, which probably isn't in play on this home right now, given when it was originated, maybe. But or you know, aside from that, then foreclosure. Like that's the natural order of things. But that's not what happens. What happens is it gets modified again. So is this going to be another chance to lower the payment for the borrower? No, this is the absurd mod where we have to jack the rate to 7%. Sure, we extend the term to 40 years, which helps a little, but nowhere near enough to combat, you know, what the impact of jacking the rate nearly 4 points is going to do. And overall, it raises the payment to $1,783, $383 a month before what they had, right? Like, as I said in the first post on this, or the first tweet on this, like that's not loss mitigation. That's just straight up extend and pretend. And
who's making the decisions here?
The FHA loss mitigation procedures. It's not the servicers. They have to do, by and large, what the FHA tells them, and that is what the FHA loss mitigation procedures effectively tell the servicers to do. That they have to offer the mod, even if it raises the payment, to the borrower, and that the borrower can accept. I mean, the borrower could say, "No, I'm not taking that." But if you're a borrower and you kind of realize this situation is hopeless at this point, it's probably in your best interests to let it run as long as you can and take advantage of that, right? Wow. And that's what happens. So they get that modification, and you know, no surprise, 3 months later, they're 3 months delinquent. And what will happen prior to February 2026 if they don't accelerate the procedures? They'll get another mod.
Wow.
At some point in the future, when 2-3 more months from now, we'll see this come across as another mod. Might drop the payment a little bit if the interest rate comes down a little bit between now and then, or between now and what the 7% it carries. But the balance will keep growing because they have to add the arrears to the balance each time, creating more of an impact to the FHA and kind of putting the home more and more underwater.
What happens to the junior loan, if they foreclose on this at some point?
The junior loan in a foreclosure will be repaid if there are funds sufficient to repay it after whatever is recovered at foreclosure sale auction. Same thing when it comes to, like, if it were a deed in lieu where that borrower just turns the keys over and then the house gets sold, right, as an REO, or for sale. But whatever those proceeds don't cover, the FHA is, I mean, technically the borrower's equity is first on the hook, but there's not really any of that here.
Yeah.
So it's going to be the FHA, that junior lien is going to be the first thing that eats the loss.
So 7 to 10 years, whatever it is on their credit report, and then they're cleared again 7 to 10 years later, and both the main mortgage and the junior lien, they're free and clear of those things.
Yeah, eventually, yeah, right. I mean, all things clear from the credit eventually, but
all right. What's your third?
Okay. The FHA move-in special turned 6 months of not paying the mortgage into a free refinance and a $50,000 interest-free loan from the FHA on a newly purchased house.
It's just party time.
It kills credit, but everyone can do it. And then, is that what we want, right? I mean, obviously, no, we don't. And I'm doing this in part to show a pattern, in part to point out another flaw within the FHA's loss mitigation procedures, and one that unfortunately persists into the permanent one. So hopefully someone from the FHA is watching and will, will address the permanent procedures to not allow this sort of situation. But what happens is, so this is a very new loan. This was, the first payment date on it was in September of last year. $348,000 loan, and it bears a rate of 7.25%, right? So this is a recent vintage loan with a high interest rate, and accordingly high payment as a result relative to the loan amount. So what does the borrower do? Well, they never make a payment. So
let me guess, they got a higher than 50% debt to income ratio.
No, actually, this one's a little lower. This one's actually 42.
Wow.
42, 52.
Okay.
Although that's one of those factors that would make you think, are they struggling or are they gaming?
Well, but then you take into account your point earlier when you were taking us through the basics of the loan, and that it's a higher monthly payment relative to the overall balance. And despite the fact that they have a almost 43% debt to income ratio, this payment happens to be higher. So it would almost act like if they had a lower payment, but yet their debt to income ratio was 50%. It's kind of equating there.
This is true. And I think to a degree, when you see the rise in DTIs and aggregate in the more recent vintages of FHA originations, that probably partly reflects not just on the cost of housing, right? But other debts that would factor into the DTI as well.
Yeah, it's just shocking that there are those that are, the FHA is willing to make these loans knowing there's a much higher probability of a problem down the road.
Yeah, I mean, the FHA has a mission to try to bring affordable housing or housing finance to first-time home buyers that are less creditworthy, etc.
And that's noble.
But yeah, I mean, they're well, and the worst part about it is their own loss mitigation procedures are making that worse, right? That by not allowing that Florida home I showed in the last example to come to market, it's helping to push up on overall home prices, and so it kind of exacerbates the problem of higher DTIs. I mean, probably the quickest cure for high DTIs in the FHA portfolio is much lower home prices, right?
Yeah.
On new originations, anyways. Okay, so this loan makes no payments. 5 months in, 6 months in, it gets a modification. So what does that modification do? Well, two things. The first thing is we reset the rate to market. So, well, that's great for this borrower because rates dipped from when they originated it to to now, and their rate on the loan dropped from 7.25 to 6.625. So that's great. That's going to help their mortgage payment. And in addition, because with the modification, the FHA targets, I think it's 25%, but it might be 20%. But they target they have a target payment reduction in mind. So the FHA also kicked in another $33,000 to pay down the principal in order to reach that reduced payment, as well as cover the 5 months of missed payments. So in effect, this borrower gets a free refinance, because when you do a modification, there aren't the typical closing costs that come along with doing like a rates refinance that you would get in a normal situation. And when I say a principal balance reduction, right, they'll have to pay it back in 30 years at zero interest for that 33, which overall lowers their payments. I think, let's see if I remember correct. So this one was a 15% lower. This one was a 15% lower payments.
Which, if they would have just done that from the start, if they would have just looked at this and said, based on your debt to income, this is what you can afford, which would be a 15% less payment per month. But instead they start out and then they got to kick in $50,000.
Yeah. I mean, that's what the mechanics allow for. I mean, how do you fix it? Well, you make it where you can't do a refinance within the first, you have to you got to make the first 6 payments or something of that nature. Wouldn't stop everything, but it would stop a lot.
Yeah.
And so, yeah, those are the examples that I have teed up for you.
All right, great.
They kind of broadly give these are the general patterns that you see over and over. There's different variations on different loans, different combinations of the two, but this is broadly describes the major problem points.
Okay, I appreciate you walking us through that. You could unshare now, and we can come back to our general conversation. So what's the depth of the issues here, the things that you've taken us through? What's the depth of this? How many mortgages are out there in these conditions? Obviously, either coming February or sooner, this is going to lead to foreclosures and short sales. What's your prediction here? Like, what are we headed towards?
Okay, so there's two pockets of distinct distress in the FHA portfolio that will be impacted when the music stops in February 2026 or earlier. The first is what I've dubbed the modifications of doom, and these were modifications that were performed largely over the last 2 years that generally were actually went to struggling borrowers who honestly answered their servicer that they need some help to be able to make their mortgage payments. And unfortunately, they got modifications that jacked the rate up 2, 3, 4 points. And yeah, maybe they got the entirety of their partial claim budget poured into the loan, but it only lowered their payment by maybe 5%. And that wasn't enough. And now they've got no partial claim ammunition left in the future. And they've got a loan with a super high rate. So there's about somewhere between 100 to maybe 150,000 of these. It's a little difficult to tell because I can only see the data for the FHAs that are in the mortgage-backed security pools, and the ones that have been removed. I don't have visibility into, but 100 to 150,000 is a pretty good, pretty reasonable, and somewhat cautious, actually, expectation of mods that are in that state. And those mods, barring a collapse in interest rates between where we are now and when the music stops, those mods have very little path to keeping the borrower in those homes. The other pocket of distress is the 360,000 partial claims that are being done a year. Now, as I mentioned, sometimes partial claims are a legit loss mit strategy for somebody who is temporarily struggling. But there's two kind of areas of concern, or there's three ways to break down those partial claims. There's the one, people who just needed it once to get them over a rough patch. They won't really be impacted by the change in loss mitigation procedures because they weren't abusing the system, or they weren't using the system because it's all they could do, and they can't afford the home. The second pot are the ones who are riding the partial claim gravy train and kind of gripped it, right? The first borrower is probably in that class where they're not making any payments at all. They're just stringing these things together. Are they going to pay? Is that borrower going to pay when the music stops? Well, a lot of those have really low rates. So actually, there's a decent chance they will, because they'll want to keep that rate. It's tough to know. Like if they're purely kind of gaming the system, then they might pay. But then that leads to the third pot, which is the ones who are using it because they're struggling and it's what's getting them by. And when that happens, when the music stops, those borrowers are going to similarly be in trouble. The FHA has better procedures now to handle getting payment relief temporarily for a borrower that doesn't involve modification that will jack the rate up. But there's going to be a significant cohort of that 360K for which there won't be really good viable paths to reperforming either. So all in, if I had to put a number at it, I'd say there's probably 2 to 250 that will go towards loss mit disposition slash foreclosure when the music stops, unless there's a significant collapse in mortgage rates between now and then, which would that would help to solve for many of them,
or some new policy that they come up with to tag along with this changeover. But
100%, if they extend this to February 2027, not that I think they will, but if they did, then that 200 to 250,000 goes to zero, or effectively zero.
So okay, so we're looking at several 100,000 homes potentially, and decent size homes, decent cost homes coming to market, adding to inventory that's already spiking in many locales around the country. Okay, so now at the same time, there's been reports that, now I know these numbers aren't accurate, but that, John, that 9 seriously delinquent FHA loans last year went to foreclosure. Now,
Yeah.
I know you're going to speak to the issue that it's directionally correct, but the number's not correct. The real question was how much of a problem is this really masking? But I think you've already addressed the issue there. All right. So,
and to be clear, I don't know that the 9 number is incorrect. That came from the Wall Street Journal article, and I don't know how they're slicing and dicing the data, but they're largely right. There's effectively not foreclosure activity that's happening within FHA.
Yeah, but under the assumption that this policy ends February or sooner, then we will have foreclosure activity taking place.
That's the catalyst. When these loss mitigation procedures end, that's the catalyst. It won't be literally that month. It'll take probably 2-3 month lag after that, because they get one more shot at loss mitigation. But this time it's real, and they have to prove it by paying it. And if they don't make the payment, then it's going to disposition.
Yeah, and so then there's going to be other cascading effects from all those folks being displaced out of their homes, and their credit being impacted officially, and many other issues. So, the high debt to income approval that FHA has, it used to be, I thought you said it used to be 40% was, higher than the 43%, and now it's maybe 2/3. And you've seen some as high in the 60s debt to income ratio?
I don't know that I've seen it in the 60s, but I've seen it in the very high 50s. So close enough.
Yeah.
Um, the
So my question is this type of approval, where it's really high probability of a problem at some point. These folks can't afford these the size of these loans and the size of these payments with all the other debt that they have relative to the income they're making, yet they're giving them the loans anyway. Is this incentivizing riskier borrowing that could backfire as the market cools down?
I mean, yeah, right. I mean, mechanically, when you have DTIs that high, then your ability, if something goes wrong in your life, um, it your vulnerability to not being able to make your mortgage payment goes up. So yeah, I mean, it can't help but not backfire for loans with DTIs, or tend to backfire with DTIs that high.
Yeah. So did this pandemic era foreclosure prevention modification policy, did it affect lending standards for new mortgages? Did it push lenders to loosen FHA criteria?
No, I mean, not really the lenders. I mean, the lenders stay within the guidelines that FHA sets, or Fannie and Freddie set, if that's where the loan is going to go, or the VA if it's a VA loan. And they, not to my knowledge in any event, that this is not a story of, the lenders loosened the lending style, the lending. It's a story of, they're stopped for a protracted period of time, right? You might understand it in early COVID, but there stopped being effectively consequences for non-payment, which is what you see in some of the example loans that I've spotlighted.
Yeah, and there's several programs like that with the student loans, having restarted within the last 12 months, or I
Yep.
don't know the exact time frame, but somewhere in there. And there's been plenty of studies done where a lot of the folks who had these pauses in their payments during that time have filled that gap with additional debt in the meantime. And so now that old debt is going to restart, pile on top of the new debt plus all the other existing debt. And that's going to lead to some consuming challenges that they're going to have.
100% makes sense. And some of the loans that I think may just be gaming the system. If that happens on them, then when they do need to make up the mortgage payment again, they may face the same dilemma.
Yeah. So, given FHA's role in approving these risky loans and bailing out non-payers, what's your top advice for agents, buyers, investors in this distorted market that's going to try to find its equilibrium here in the months and years to come?
I mean, from an investor's perspective, and it depends on what type of investors that we're talking about, but I think the investors and servicing companies, mortgage servicing companies need to be cautious, particularly for servicers that might have a large exposure in the FHA space, because the servicers benefit from these partial claims and frequent modifications as well, because their liquidity is restored, right? Like, for folks who may not know how the mortgage servicing works, if the borrower stops paying, the servicer themselves have to actually step in for the borrower, and make those payments. So when I say the FHA is covering them, they are, but they do it through those partial claims where they basically reimburse the servicers, and that's fine, right? I mean, the servicers don't like being out 5 months or 6 months or 7 months at a time, but that's better than getting into a protracted 12 to 18-month foreclosure process where they've got to float that liquidity for the entirety of that process. And that there's a very significant risk, particularly for any servicers that are exposed to a number of these modifications of doom in the FHA that's coming up. And then for the broader market, I mean, there was a time when short sales and for sales and REO. There was time when that was a thing, and that will eventually kind of make its return. And in FHA world, that'll kind of come back with a initial large impulse, right? It'll settle down as the ones that those doomed mods get filtered out, but there'll be, kind of like the water's releasing behind a dam. It'll go from nothing to quite a lot in a very short period of time.
John, with the FHA mortgage delinquencies soaring that you've talked about here, and 42% of homeowners unable to refinance due to tight credit markets, how could a wave of all these forced sales that you're talking about impact home prices and really the broader economic stability?
I mean, from a home price perspective, it's certainly not going to help home price valuations, right? I mean, it's a downward pushing force. How significant is this? Let's say it was 200,000. How significant would that be? I don't know. I'm not a housing expert in the impact of inventory and the rest of it on that. So I don't know. I just know that that's not going to be good for it in terms of and when you get if we start to see declines in home prices, then you're going to get knock-on effects that come with that.
Yeah, and it sounds to me like it's just another headwind. There's been many headwinds that are beginning to accumulate here in the housing market. Sales are at multi-decade lows. Things are stalled out, and inventory's rising, and there's other issues, and it just seems like there's headwinds that are building, and now this is another headwind that's going to be thrown into the stew. And who knows? I'm not looking to make any predictions, but who knows where this is going to ultimately go. John, I really appreciate you coming on to Metals and Miners. Thank you so much. You've been so generous with your time, analysis, and ideas. Would you share with everybody where they can learn about your work and how they can connect with you?
Absolutely. So they can follow me on X at John Comiskey 77, or they can read my work at my Substack, which is johncomiskey.substack.com. The title of which is Reverse Engineering Finance, where I go extensively into the real data behind the mortgage data, right? Like I don't just look at the headline delinquency rates, go much deeper in, and then also talk about other subjects like the Treasury General account and where that's going to go, and make ex-date predictions and the like.
Okay, wonderful. I really appreciate you being on. It's been a wonderful discussion, and I hope everyone has gotten a tremendous amount out of it. I look forward to having you back on sometime soon to do part 2. We'll catch up. We'll see where things stand, maybe near the end of the year. Thanks for being here again, and everybody else, thanks for watching.
Absolutely. Thank you, Gary. Appreciate it.